Hi. In my recent book, The Advanced Sleuth Investor, I look at investing from several professionals' viewpoint: accountants, intelligence agents, physicists, historians, chess players, and more. I already got several thank you emails about the book, which sort of made writing it worthwhile. Now, as a bonus for these thank yous, here is one more analogy: boxing. There's a brief allusion to it in the book, but here it is in an expanded form. Now, why is this useful for your investing success? Because the similarities of boxing to investing are striking, as you'll soon see. Let me start on the basics of picking the best stocks. The best stocks are those with the following three characteristics. First, they grow faster than the GDP, preferably much faster, all the time, not just 2 years every 5. The latter are called cyclicals and are for traders. Second, management drops much of these rising sales to the bottom line. So it's not just lots of sales at any price. What you want is money in your pocket, the shareholder. Third, the company does all this magic with as little capital as possible, both equity and debt. That is, high return on invested capital. That's it. You want fast growers with fat margins who need few dollars of capital to grow. You may ask, isn't all this too much to ask for? Yes. Maybe only one company in 100 comes even close to this, maybe one in 200. But so what? You don't have to consider all companies and all stocks, only the best. So ask for all three criteria, nothing but the very best for your portfolio. Same as the criteria for entry to Ivy League schools, by the way, or to the Navy SEALs, or the Top Gun Academy of the Air Force, or to the Juilliard Music School. None of these organizations take almost best or also run. And so shouldn't you. Now, where can you find such top companies? You can run a screen via Bloomberg or Capital IQ, also known as CompuStat, or anytime you look at a stock, just run a quick calculation about these three numbers: sales growth, gross margins, and return on invested capital. Then sum them up. Look and consider only the top values, nothing else, as per my book. Okay, so now you know how to stick to the very top stocks. But where does the comparison to boxing come in? Like this. In boxing too, there are similarly three characteristics that often determine a win. The first is the amount of punches that the boxer throws at the opponent. All the punches. That's equivalent to sales. That is, raw activity that costs him energy. The second is the number of punches that land on the opponent. That's only actions that ended with a profit, equivalent to gross margins. The third is the effect of the punch per energy expended. That's equivalent to a stock return on capital. In boxing, the best punches are focused, sharp ones that connect, but that need minimal body movement. Here's an example of this via the most classic boxer of all, Muhammad Ali. When I boxed in my university days in the prehistory, he was still called Cassius Clay, but I'll call him Ali because that's how he's known today. Our boxing instructor, a short Russian guy built like a tank, made us see movies of all Ali's fights at the time to learn his tricks. Those, by the way, were pre-YouTube days, so we had to watch them on the reel. So how did Ali stack up on these three boxing categories? First, the number of his punches was much higher than his opponents. Second, a large number of his punches landed, mostly due to Ali's extreme focus and speed. But third, and least appreciated, Ali's punches used energy very economically, unlike George Foreman or Leon Frazier later or Eugene Burbick. Ali didn't swing his entire body, just a fast hip turn and a precise arm snap, yes, like a bee sting. And before you knew it, Ali's arm was back in defensive position while the opponent's head was suddenly 1 foot backwards. All in all, Ali had high number of punches, most of them hit hard, but with the least amount of energy expended by him. These, said the instructor, are the ideals to strive for in boxing, while at the same time keeping the opponent at a safe distance, margin of safety. And in all this, yes, are directly analogous to the best stocks to look for. You want high sales activity, fat harvest of profits from the sales, and doing it with the least capital energy. Now, is this then the entire comparison of investing to boxing? Nope, it's only half of it. Winning in the ring is not just landing the hardest punches with the least effort and energy. It is also keeping yourself protected while the opponent is doing his best to land his punches, spending his energy, preferably uselessly. And in this regard, Ali was by far the greatest. And he did this via his rope-a-dope method, which he used in his famous battle with Foreman. What was this strategy, and in what way is it analogous to investing? Well, George Foreman was a formidable opponent with a huge swing and an awesome punch. True, he was not as fast as Ali, not really, but the punch of his that did connect could deck Ali if he was not careful. What Ali did then was to try and waste Foreman's capital, his energy, while preserving his own. To do this, Ali stayed on the ropes, locked up defensively, and let Foreman land as many of his wild swings as he wished, while minimizing their effect by catching them on his forearms and elbows. You may say that Foreman had large sales growth but low margins, and these were very wasteful of his capital energy. So when Ali finally came out swinging, Foreman was almost totally out of capital energy, and as Ali connected with nearly all his punches, full power, he won the fight. This was rope-a-dope. So again, what's the connection to investing? It's simply this. No matter how good a stock you choose and how well you sleuth the company behind it, every few years it will punch you wildly as Foreman did Ali when Mr. Market becomes a bear or crashes, and the stock will go down with it. And it is then that you have to stay in the ring, stay invested, but play rope-a-dope. That is, do nothing, stay defensive, breathe deeply, and wait for Mr. Market to tire of its antics and bearishness, and then the battle will again go your way. And just to make this clear, here is an exercise for you that will make it vivid. Take a look at Appendix 1 in my book, The Advanced Sleuth Investor. It has a sample of 15 stocks of high Q, high quality, that is fast sales growth, fat gross margins, and high return on invested capital. Since the book was published half a year ago, these high Q, high quality stocks rose 18% on the average versus 10% for the SPY and 13% for Berkshire, Buffett's company. Nice? Sure is. But here is the exercise. Now go to your favorite charting program, I know you have one, and look at all these stocks as far back as the chart goes. Then compute two numbers. First, look at the biggest drawdown in the life of the stock. That is how deep the stock plunged peak to trough. As you will see, even the best stocks often had 50% or 60% plunges, sometimes even more. That's equivalent to how strong a punch the stock and Mr. Market managed to land on you. It's analogous to how deep a decline you can take without panicking and selling. As I said, some stocks plunge a lot before continuing their climb. But second, measure now how long it took the stock to recover to its previous peak. That's equivalent to how long the stock kept hammering at you, like Foreman at Ali. Some stocks stayed down for 3 years, some 4, say even 5 years or more. How long would you last before you threw in the towel and sold out? In sum, before you start investing in the long-term multibagger, you must ask yourself the same question you should ask before you climb into the boxing ring. How long can you stay defensive and do nothing while Mr. Market is hammering at you? How long can you hold on to your long-term multibagger or potential multibagger even as it plunges deeply? You could stay if you sleuth the stock on a physical level, so then you'd know what others don't. If you don't, you'd fold and lose out on all the upside. So learn to play rope-a-dope, and you'll be able not just to find multibagger, but also stay with them. It, of course, would help you if you train yourself to stand such pressure. But train how? Read my book, The Advanced Sleuth Investor, and see the last chapter exactly how you can do that, just like athletes, Navy SEALs, and Top Guns do. That's all for today. Please like this clip, retweet to all your friends, and subscribe to the channel, and buy my book, and write a review for Amazon, which I hope will be a good one. I'll see you next time, and meantime, thank you very much for watching.